Good morning, all. Good morning. Just going to give a few seconds for the attendees to enter the room, and then we'll get this underway. Okay, excellent. Wonderful. Right, so good morning, traders. Welcome to this special webinar on, let me just check the all right, good. Just bear with me. All right, so welcome to this special webinar on risk management and in trading and investing. Now, while the title of this presentation may not generate fireworks and send us all running to learn more, it should. I say this simply because no matter how wonderful your trading system is, no matter the win percentage, no matter the profit factor, risk management will keep you in business and help mitigate the dreaded margin call. So I strongly encourage all attending today to continue their education in managing risk, of course, after this session. As to be frank, as traders and investors, we are risk managers first and foremost. Now, risk and return in investing and trading is at the forefront of our required knowledge. Every trader, no matter who you are, experiences losing streaks, and we must have ways of mitigating this, the negative influences. So importantly, we all have different preferences in terms of when it comes to risk, and some are more risk averse than others. For example, for those of you, just briefly, for those of you who are unaware of who's behind the mic, my name's Aaron Hill, and I'm one of the market analysts here at FP Markets. As usual, there should be no issue with sound or the visual from the slides. If there are, do let me know, and I'll be sure to pass this on to our support team. For any recordings, these will be available following the end of this presentation, either through YouTube or through our main webpage under resources. You'll see a link in the chat box to access any archived webinars. It's fine to fire across, excuse me, guys. It's fine to fire across any questions you have during the presentation, but if it's something you feel may require a more in-depth response, please consider waiting until the end of this presentation, as we may clear up any queries as we proceed through the presentation. Now, as usual, really quickly, let's skim through the disclaimer. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. Now, really, what I'm saying here is anything we discuss today is not investment advice. It's purely an educational webinar. All right. So in terms of the excuse me, in terms of the content, we're going to be looking at what risk management is, what is it, how do we define risk management, and then we'll look at the certain risk management techniques. Of course, guys, this is an hour-long presentation, and I won't be able to cover all of the risk management techniques available, but I will ensure that I touch on the most, some of the most popular and some of the most useful for us as retail traders. And of course, a Q&A session will be available at the end. Now, in every webinar, I do say this, so any questions I miss or any that require further additional, a longer than necessary, a longer response, please consider emailing the research team at market analyst at fpmarkets.com. Or alternatively, guys, you can use the support email. This is support@fpmarkets.com, and we'll happily get back to you as soon as possible. Also, you can use these emails to send across any future webinars you would like us to consider. There will be a link in the chat box shortly for those emails. All right, so what is risk management? What does it mean? Well, for me, risk management is essentially mitigating preventable negative price fluctuations in your trading or investing. So risk is a term that can really give rise to a few different meanings, and it really depends on who's asked. So if we ask an everyday investor, their response is likely to be that risk is simply the amount of money he or she could lose. So if we ask a finance professional, so that someone working in a bank or in some professional field, they will likely state that risk is defined as the standard deviation of periodic returns. I know that's a mouthful, but if you do a quick Google search, you will find out that it's quite a simple. It's a relatively simple approach. The professional, therefore, does not really classify risk in terms of a dollar amount or a pound amount, depending on where you're from. But it's more as volatility, or shall we say dispersion or variance from a central tendency. So for anyone that's familiar with statistics, you'll know what I'm talking about. So think of a Gaussian distribution curve, and the central line is your central tendency, and the variance is either side of that central tendency. To the right is positive variance, to the left is negative variance, and these are used with risk calculations such as the Sharpe ratio and also the Sortino ratio. We will be looking at these at the end, guys. So look, we're all aware, or we should be, that all investments do indeed carry risk. But there are two fields of risk that are important. Sorry, guys. As I said, there are two fields of risk that are important to understand. And one of these fields of risk can essentially be mitigated through diversification. And another is unfortunately unavoidable. So the point is, not all risks are equal. Now, as you can see on the slide here, we have what's known as systematic and unsystematic risk. This is a little bit of an advanced concept, but I felt it was certainly worth going over. And so I will not go into the calculations of the two components. Well, we'll touch on a little bit of it, but nothing that goes too in depth. So starting with systematic risk, this is also known as undiversifiable risk or market risk. So what this does is as you can probably tell from what I've just said, it influences the entire marketplace rather than just a particular sector or industry. So just for anyone that's unaware, an industry refers to a much more specific group of companies or businesses, while the term sector, it really reflects a larger segment of the economy. Now, systematic risk, as I've said, is unavoidable, and hence it cannot be diversified away. It cannot be. We cannot use diversification to decrease this risk. It is based on market conditions or factors. So think of things like inflation, which we're all aware of at the moment, given global inflation currently. Interest rates, and we're all aware of that, right? Central banks have embarked on a aggressive policy tightening. Major central banks, of course, have embarked on a major policy tightening phase. So we're all aware of that. And as you can see, this is systematic risk. So interest rates, inflation, the business cycle is certainly something to consider. Political uncertainty is another one. And of course, natural disaster. Therefore, there is really no way we can avoid systematic risk entirely. But importantly, the point I really want to get across is it can be magnified with leverage. So it's important to understand leverage, and it's important to understand margin. Now, we will be touching on this during the presentation. Now, as I said, systematic risk cannot be diversified. It cannot be eliminated by adding more assets to a portfolio. Assuming you're a portfolio manager, you manage your own portfolio. It can, however, be slightly reduced through efficient asset allocation. So, for example, let's say a portfolio consists of equities, bonds, real estate, and say gold. This has a lower systematic risk than say if we're just comparing an all equity portfolio or just say an all bond portfolio or someone that just trades or invests in commodities. This is because certain systematic risks affect different asset classes differently, of course. Now, although I said I would not get into the calculation, just really quickly, for those interested, systematic risk can be measured through what's known as the beta coefficient. Now, beta is a measure of the stock's volatility in relation to the overall market. Now, the overall market can be the S&P 500 index, for example, based in the US. Now, assume this has a beta of 1. And individual stocks are ranked according to this, according to how much they deviate from the market's beta. So look, a higher beta coefficient means higher systematic risk and vice versa. So a beta coefficient of 1 would mean that the investment has equal systematic risk to the overall market. That's just an example for you guys. All right, so unsystematic risk, really, or non-systematic risk, you can call this, or even diversifiable risk. Now, this is confined to a specific asset class or security, and really is essentially a function of the behavior of a particular asset. Now, in this case, unlike systematic risk, portfolio diversification can help mitigate non-systematic risks, and it reduces exposure and reliance on one specific asset class. Now, unsystematic risk, you may also see this referred to as asset-specific risk, meaning the dangers that are really unique to a single company or even industry. However, these risks do not only occur one firm at a time. So if poor management is the norm in a certain industry, the stocks of many firms could be affected, if that makes sense, simultaneously. Other examples of the diversifiable risk, which really focuses on the microeconomic side of the table. We can think of things like changes in regulations or that affects one industry, for example, or an entry of a new competitor, which, of course, in microeconomics would cause the supply curve to shift to the right, meaning more quantity is produced at the same prices, assuming demand remains constant. So other examples are management risks, of course, as we said. So so poorly managed companies. An employee strike is another one, of course. Now here you can see we have designed an image which has portfolio risk on the y-axis and the number of assets in your portfolio on the x-axis. Now, portfolio risk represents standard deviation, and yes, so this is the volatility of one's portfolio. So the green, the black negatively sloping line reflects the relationship between risk, that's the portfolio risk, and the number of assets. So assets added to our portfolio through correlation coefficients, if you will. So diversification works best when assets. So the number of assets in our portfolio are uncorrelated or negatively correlated with one another. So that's some of the parts. Just bear with me. Sorry about this. All right. So that as some of the parts of the portfolio fall, others may rise or will be unmoved. So in investment, diversification essentially means allocating funds among the different asset classes. So if one asset takes a loss, as I'm sure you know now, the money invested in others may not be affected as much. Now, do bear in mind that investors are really only compensated for taking on systematic risk. As I've just shown here, unsystematic risk can effectively be diversified away. Now, I won't go into any more detail of this. Do have a look at this, because it's quite interesting for in terms of risk management. Now, other forms of risk you may have heard of, which I don't really have time to go into, are exchange rate risks. We have also things like interest rate risks, liquidity risk, credit risk, default risk, equity risk, which is a type of market risk that applies to invest in shares, of course. And we have things like a volatility risk. Now, as I said, I don't have really time to go into that, but let's move on to the next slide. So now, sorry, guys, just bear with me a minute. So common sense risk controls. Now, this is something I learned early on in my trading journey. Thankfully, I did anyway. And as its name implies, this is something I believe we should all consider employing, as it really is common sense to employ some form of risk management. As void of risk management, guys, your portfolio, your trading account may be short-lived. So as you can see here, only risk what you can afford to lose. That should be, that's self-explanatory, guys. Only risk what you can afford to lose. Don't risk money that you're using to pay for housing or food or other bills. Only risk money you can afford to lose. All right, so know your exit. Here, what I'm referring to here is knowing your exit, so planning your trade accordingly. So are you... if you're long the market, understand that where your exit is. Now, that does not mean that you should have fixed take profit targets. I do not really mean that. What I mean is, even if you're trailing a position, understand where you should know. Before you hit that entry trigger, you should know where you have to begin employing your trailing stop. So are you using, say, for instance, an ATR trailing stop, for example? You have to understand this before you exit and enter your trades. Don't figure this out after the trades are being executed. The third one is risk small amounts of account equity. Again, this is pretty. This is common sense, guys. Really, isn't it? If we want to be frank, if we risk 50% of our account, it's very unlikely we are going to survive and have a long trading career or investing career. So the general rule of thumb is risk 2%, right? Risk 2% of your account. Look, I know a lot of professional traders who trade large accounts, and they do not risk 2%. They risk a lot less. So one that comes to mind, he risked 0.5%, so 0.5% of risk, but he was trading a very, very large account. And he was also trading futures as well. So futures and FX. Protective stop loss orders, guys. Protective stop loss orders are there to protect you. They are there to mitigate downside fluctuations in your account. And look, without a protective stop loss order, let's say a black swan event occurs. So let's say you remember back in 2015 when the Swiss National Bank unpegged the euro, the markets went insane, didn't they? Especially for Swiss-based pairs. Now, imagine if you didn't have a stop at that time. Now, to be clear, even with a stop, the slippage would have been pretty insane. But in the time you would have tried to get out of the trade, your stop would have taken you out quicker. That's my point. So it's there to help you. It's there to help mitigate further damage to your account. That's the main point, really, with protective stop loss orders. Yes, so that's really it. So any questions on common sense risk controls, do let me know, and I'll happily go over them in more detail. All right, so guys, hedging. What does it mean to say when one hedges a position? So to hedge a position, It essentially means to offset potential risk of negative or adverse price movements. Look, it really is. It can be a somewhat sophisticated area of risk management, but I do want to go over it briefly here. So first and foremost, guys, at its simplest, we can nowadays adopt what's known as direct hedging in FX. Now, this is one of the most basic and simplest hedging strategies. So as a very basic example, if you're long, if you've bought into the pound dollar, let's say pound dollar of a specific size, say 100,000 units, a standard lot, a direct hedge involves taking an exact mirror opposite trade for the pound dollar. So you'll be short the pound dollar of 100,000 units. That's very basic. So as far as I'm aware, this is only possible, though, when the broker adopts what's known as a hedging system. Now, I do believe most brokers now do offer this this feature, which really allows as many open positions in different directions as you wish. Now, before, I think it was a number of years ago, brokers tended to adopt a netting system, which only allowed for only one open position in any direction for one investment. Now, as you can see on the second tab here, diversification, we've really gone over that. So diversification is also a form of hedging, as I said, we've already touched on. It's basically not putting all your eggs in one basket. Another well-known form of hedging, of course, involves the options market. So you can use strategies such as you can see here, the protective put. Now, puts give you the right, but not the obligation, guys, to sell your stock at a specified price for a specified time. So you can choose at which you can choose the price at which the put sells, and this is known as the strike price. And this provides you with a secure floor for your stock's price. Now, protective puts can limit or essentially eliminate losses, but they aren't free, guys. You have to pay. And this is where the premium steps in. So a premium is paid to the writer, so the seller of the put. So you could lose it if the option does not reach the strike price. You will essentially lose the premium that you paid. But look, the idea behind the protective put is insurance. So if you believe that there will be some negative price fluctuations to your portfolio, to your equity portfolio, you can take out a protective put on, say, the S&P 500 or something like that. It's just there to protect you. So so hedging a stock really means buying an asset that will move in the opposite direction of that stock. As I said, really the hedge could be in the futures market. It could be a direct hedge. It could be in the options market, or it can just simply be a short sale. All right, guys, leverage and margin. Now, this is something I see a lot. This is more on the retail side, guys. So this is more this should relate more to us as traders and investors. Now, I thought I needed to include this because many are often confused by these concepts in the CFD market. I certainly was in the early stages of my journey. There was a number of times I thought that leverage in the derivatives market was borrowed funds. It's not. This is something that really confused me until I actually learned how the system works. So again, guys, look, knowledge is a form of risk management. I should have really put that in the common sense risk controls. Knowledge is risk management. If you don't have the knowledge to trade a specific asset class, and you don't have the knowledge of their execution methods for the market that you're trading, so futures, options, CFDs, then you are at risk of making a mistake and potentially losing unnecessary funds in the process. So knowledge is a form of risk management as well. Now, leverage and margin, guys. Leverage, margin, and position sizing in the CFD market is vital knowledge. Now, if we cannot calculate our position size correctly, this could lead to all sorts of troublesome situations. Now, to kick this off, let's understand that leverage and margin work together. Let me repeat that. Leverage and margin work together. Now, I'm primarily going to discuss leverage in the FX space here. It's because I'm basically an FX trader. This is what most of my focus is on. So as I've said, leverage and margin are often misunderstood concepts, particularly in the derivatives market. Now, it's important to understand that there is a relationship between leverage and margin. They cannot really exist without one another. Leverage is achieved. This is really important, guys, this point here. Leverage is achieved using margin. Leverage is achieved using margin. So when you hear of you're using too high of a leverage ratio, I think what they mean is your position size is too large. And yes, because leverage, as you can see here, leverage is a fixed ratio. It does not change. Leverage could be 30 to 1, which is very common nowadays. It could be 100 to 1. It could even be 500 to 1, or on some brokers I've seen 1,000 to 1. It's quite ridiculous, really, the size of leverage you can have in the CFD market, especially at 1,000 to 1 is insane. But look, I really want to emphasize this point. Leverage is achieved through the initial margin to execute your trade. Now, the initial margin provides downside protection for the broker and the trader should adverse price movement unfold. Now, as I've said, leverage is a fixed ratio. This will not change unless, of course, you go through your brokerage's client portal, and you can change it there, I believe. And within the derivatives market, leverage is not characterized as a loan. The brokerage is not lending you anything. Think about this logically. If you take out a standard lot on a trade, that's 100,000 units, 100,000 pounds or 100,000 US dollars for one trader. Now imagine if we have 10,000 clients, active clients. That is insane amounts of money. I don't think any broker has that type of capital on to lend out for, quite literally, for not much interest. So think about it like that as we progress, and it should make more sense. Now, traders and investors can measure their effective leverage. Now, their effective leverages can also be referred to as true leverage. And how this is achieved is by dividing the notional exposure of the position by the trader's account equity. So look, a very basic example of this really is off the cuff, guys, 100,000 unit position in the foreign exchange market. So that's a standard lot, guys. That's a standard lot. So 100,000 units of the base currency of the currency pair. Now, if we divide that by the account equity of, let's say our account equity is 20,000, keeping it nice and simple. And what this does is provides us an effective leverage of 5 to 1 for that trade. So all we've done, 100,000 units, that's our position size. We divide that by our account equity, which is 20,000, 100,000 divided by 20,000 gives us 5 to 1. So this really informs the trader or investor that they are trading with exposure of 5 times their account equity. So how do we calculate the margin percentage? How do we calculate the margin percentage? Well, there are calculators available on almost all brokers now. I do feel it's good to understand the dynamics behind manual calculation. This goes for position sizing as well, guys. So let's start off with a very basic understanding. So how do we calculate the margin percentage? Now, the leverage ratio, as I've said, is fixed. So let me get the pen out. So let's imagine our leverage ratio is 100 to 1. Okay, that's our leverage ratio. That's fixed by us and the broker. So our leverage ratio is 100 to 1. Now, this is fixed, as I said, but to calculate our margin percentage, we need to divide 1 by 100. Okay, and what that does is that gives us our margin percentage. That provides us what our margin percentage will be, and in this case, it's 0.001. 0.01, which is 1%. All right, so with that in mind, so the leverage ratio, as I've said, is fixed by your broker, highlighted above. Really, what that provides is the margin percentage rate, and it's simple division, right, guys? 1 divided by 100. All right, and if it's 1 divided by 30, let's assume your leverage ratio is 30 to 1. That would be 0.033, so 3.3%. So as you can see, our leverage ratio is fixed, but it has a relationship with our margin percentage. So leverage, and margin have a relationship. Okay. So a higher leverage ratio. So let's imagine our leverage ratio is 500 to 1. Now, if we divide 1 by 500, we get, I think it's 0.2%. 0.2%. Now, that's our margin percentage. Here, it's 1%. Here, it's 3.3%. All right. So really, this really relates to this point here. Higher leverage equals a lower initial margin. So as you can see here, the higher leverage equals a lower initial margin. A lower leverage ratio equals a higher initial margin. All right. So that's the initial margin is what we have to essentially. I don't like the word deposit, but it's almost a collateral deposit that gets removed, gets locked in your account when you execute a trade. Now, I will be showing this on the terminals shortly, so it should make more sense. So knowing that the margin rate, so let's work with this one, knowing that the margin rate is 1%, we can calculate the initial margin, the monetary amount required to trade. However, this does depend on a number of things. This depends on the account's denomination. You'll see this shortly, guys. The currency pair traded, the leverage ratio, and of course, the position size. Now, if you're interested in finding out more about position size calculation, manually position size calculation, you can find that out in our Trading Academy. We have videos and we have in-depth articles on that explaining the calculation. Let me just be clear here, guys. Miscalculating one's position size really can lead to a higher initial margin and requirement, and ultimately where none of us want to be is a margin call. So the point I really want to get across here is it's not so much the leverage ratio that we should be focusing on, because as I've said, that's fixed. Although all the leverage ratio really tells us is how much initial margin we need. It is largely the position size we need to focus on. As I've said, miscalculation, the miscalculation of one's position size can lead us to a really difficult situation, and could, as I've said, again, I'm repeating myself here, but it could lead to a higher initial margin, and ultimately, depending on how much free margin we have left in the trading account, it can lead to a margin call, or worse, hitting the broker's stop out level, which I will be showing you very shortly. Now, this is really a margin calculation and position sizing, an example, guys. Now, if you want more details on this, as I said, visit the Trading Academy. There will be a link in the chat box shortly at the end where you can go over this in detail. And we have videos as well to support this. All right, so margin calculation here. This is your margin calculation on the left here. Let me just get the pen. Bear with me, guys. So this is the margin calculation here. And we're working with an account denominated in the same currency as the currency pair's quote currency. So for as an example, if you're trading the, let's say, pound, your account's denominated in the GBP, and you're trading the Euro GBP. All right, the Euro GBP. So the margin rate, to calculate the margin rate, you first have to find your position size. Let's imagine that's say, so we've got the example here. I should have really focused on this example, to be quite honest with you. Forget this one up here, guys. Sorry about that. So our account currency is in Aussie dollar, and we are trading the Euro Aussie dollar currency pair. Now, as of writing this, let's imagine in this example, the Euro to Aussie dollar exchange rate is 1.56932. Now, our position size, which you can find from calculating the position size, which is to the right, guys. Let's imagine this is 100,000 units of the base currency. So we have all of our information required to calculate the margin rate. So position size, 100,000 units multiplied by 1.56932. Then we take that value and we multiply that by our 1%, because we know that. How do we know that's 1%? Our margin percentage here. How do we know that's 1%? We know that through the leverage ratio, which is, remember, 1 divided by 100 gives us 0.1 or 1%. And that will tell us that we require a 1,569.32 Aussie dollar initial margin to execute this specific trade. So that is what we will need in our account. Okay, as used margin. We obviously want more than this in the account, because we do want to see we do want to price action will, of course, fluctuate. Okay, so position sizing example. This is where it gets a little bit more trickier. In this example, we're looking at the account currency denominated in the same currency as the currency of the denominated in the same currency as the currency pair traded. All right, that should not have been written like that. Let me just think here. So we got the example. So we have a British pound trading account, and this particular trade, we're trading the euro pound. So we're doing the same thing as what I set up here. So we're trading we have a GBP trading account of 10,000 pounds, and euro, we're trading the euro dollar, and we're happy risking 2%, which is £200. I'm sorry about that, guys. That shouldn't have been written like that, I don't think. The account currency is denominated in the same currency as the currency of the currency pair traded. Yeah, that should be the quote currency. I apologize for that, guys. And the distance for the protective stop loss order is 30 pips. As a result, as I've said, this will likely be a day trade. So the formula to determine the position size when your account currency is denominated in the same currency as the quote currency of your currency pair traded is very, very simple. All you do is take your trade risk and then divide that by 0.0030, which is, of course, the 30 pips. So remember, guys, pips are usually quoted out to the 5th decimal place. In this case, I haven't really shown the point, so that's the 5th decimal place. There's no point really here. And then by dividing 200 by 0.0030, we get 66,666 units, or 0.67 volume in MetaTrader to trade. So for those interested in the margin calculation for this single trade, which you can get from this formula up here, the calculation for this single trade, assume a 1% margin requirement, again, same as up here. And the euro pound trades at 84.33, trading 4 mini lots. 4 mini lots is 10,000 units, guys. So that's 40,000 units. This equals around a 337.32 deposit. Initial margin. Article. Okay, cool. So we're all. Any questions on this? I don't see any questions coming through. Nope. All right, fantastic. All right, so let me clear these drawings. All right, so margin call. This is an interesting one, guys, because, again, a lot of newer traders struggle with this kind of thing here. So while understanding the meaning behind a margin call is important, now a margin call is not where the broker jumps on the phone and starts screaming down the phone to deposit more funds. It's not how it works. We also need to understand that the meaning behind the broker's stop out level. This is something that should be understood by all traders. Again, guys, knowledge is a form of risk management. Knowledge is a form of risk management. So a margin call occurs when a trading account no longer has any free margin. So this is my account here. This is a demo account, guys. And I'm currently long on the euro dollar. I think I'm long. Did I buy here? Yes, I'm long the euro dollar with a size of 3 standard lots, just to be clear. All right. So a margin call occurs when, as I've said, let me just get the pen out so it's clearer. Actually, let's use the highlighter. So a margin call occurs when the account no longer has any free margin left. Okay, no more free margin. That's disappeared. That's down to 0. Okay. That is the point where really equity is equal to our margin level. So equity would be, in this case, if equity dropped down to 10,624. So if equity drops that far south and it equals 10,624, this is when your terminal here will turn red. All of this will turn red. And this is your margin call, guys. This is what they mean by margin call here. So if equity drops to 10,624, this is your initial margin here, guys. Look, I'll just quickly calculate that for you because this is a dollar account and we are trading the euro dollar. If you remember, this is the same calculation as this: position size multiplied by exchange rate multiplied by the margin percentage. So let's quickly do that now. So position size is, just trying to think, position size is 300,000. 300, let me see if I can get the calculator up here so it'd be easier. No, I don't have access to that. Sorry about this, guys. So 300,000 multiplied by the exchange rate, which is the price that I traded this at, which is 0.6248, multiplied by 1.06248. That's 318,744. Then we multiply that by 0.033 to get our free margin here. Okay, so do bear in mind that this account's leverage is set to 30 to 1. So remember, we have to take that into account. That's 3.33% margin rate. So that's our initial margin calculated, but we don't need to calculate that, guys. That's automatically done for us. I was just giving you an example. Now, just to be clear, how we calculate how do we get this free margin here? So free margin means how much we have left to open additional positions and how much the current position here can go against us. This is simply equity minus the used margin or the initial margin. Okay, so equity minus is the difference between these two here, guys. Now, to get your margin level or your margin percentage, it's equity divided by your initial margin, and that will give you that amount there. All right, so let me just check something. All right, so I'm just checking the questions here, guys. All right, so there's one question here. Could you please explain the volume in micro lots? So micro lots, so we have a standard lot, right? The standard lot is 100,000 units. Then we have what's known as fractional lots. We have a mini lot, which is 10,000 units. And then we have a micro lot, which is 1,000 units of the base currency. So it's the same, really, guys. It's just a fraction of the standard lot. There's not really much. I mean, when you're doing your position size calculations and your margin calculations, you will need to take them into consideration. We have another question here. Leverage ratio. Is it different for each traded item? So as I said, I only trade the FX market. I'm not sure for the indices and things like that. You'd have to talk to our friendly support team. I'm sure they can answer that with a quick chat on the live chat system. Another question: if I do not respond to margin calls, which orders are to be closed by the system? So just to be clear, I'll answer that question shortly regarding the margin call. So look, just to be clear, a margin call does not occurs when a margin call occurs when a trading account no longer has any free margin. So what you'll see is your equity is equal to your margin. As long as equity remains above margin, you will not receive a margin call. When I say a margin call, that means this area here turns red. Now, if this occurs, if your equity drops to 10,624, what do you think this means for free margin? Remember, equity is the difference. Free margin is the difference between equity and margin. So this would mean free margin would be 0. So you cannot open any more trades. You cannot open additional positions unless your position turns back in favor. I hope that's clear, guys. So when the terminal, or if the terminal turns red, this is essentially a request to bring margin deposits up to at least the initial margin, right? To keep existing positions open, or even liquidate a portion of your current positions. Now, what's important to understand is the brokerage's stop out level. This is often left out. So if equity, so imagine we are now, this is 10,624. It equals the same level. It's the same as your margin level. So we have received a margin call. But imagine if this drops below that. Imagine if the position keeps coming, dropping against us. So we are now down to 9,000. We are now down to 8,000. What happens then? This is when things can be really, really difficult, because brokerages work with what's known as a stop out level. And with FP markets, we work with a 50% stop out level. So if the price is 10,624 here, it's the same as your margin level, but it drops down to 5,312. We are now 50% below margin. What this means is the broker will, as its name suggests, the broker's stop out level. This is where positions are automatically closed to avoid the account going into negative territory. So that's to avoid your money literally going into a negative territory where you could end up owing the broker. Okay, so and how FP markets do this is if it reaches 50%, FP markets, the risk dealing team automatically close the first most losing position. I hope that answers your question there. We had a question on the margin calls. All right, so let me go to the next one. So risk measures. Finally, guys, risk measures. So popular risk metrics to be aware of when assessing the efficiency of a trading system. Really, my first one is drawdown. I think this is very important, and you will see this on the MetaTrader charts. We have absolute, relative, and maximum drawdown. So let's just do a quick calculation here. So the absolute drawdown, the first one here, represents the largest balance drop below the initial deposit. So our initial deposit was 5,000, and we dropped to 4,000. Okay, so 5,000 minus 4,000 gives us 1,000. So hold on, just bear with me a minute, guys. So yes, so 1,000, so 1,000. So assume this is US dollars, 5,000. So it's 1,000. So it's sorry about this. So the difference between 5,000 and 4,000 is 1,000. So that's our absolute drawdown at this point here. Absolute drawdown. Now we also have something that's known as the relative drawdown. Now, relative drawdown is percentage terms, and it's between 2 points. Now, the relative drawdown we can see is the maximum relative drawdown was from 6,000 to 4,000. Now, to calculate percentage in percentage terms, is 6,000 minus 4,000 divided by 6,000, and that would give us around 33.3%, guys. This is the difference in monetary terms of 2,000, but this is the relative. This is your maximum drawdown in relative terms. Finally, we have maximum drawdown. Now, maximum drawdown is the largest decline in capital from peak to trough. All right. So here we have from 8,000 to 5,500, and this is simply 2,500. Now, you may be asking why this is not also the relative drawdown. This is because if you calculate the percentages from 8,000 to 5,500, it's actually 31.25, which is less than this here. All right, so that's drawdown. Look, the point I really wanted to get across here is higher drawdown means higher chances of losing your total account. And of course, lower drawdown means lower chances of losing your whole trading account. So this is something you want to pay attention to when you're looking at investing in a trader or investing in a trading system. You want to look at the drawdown, because it's all well and good if the trader earns say 100% a year or something like that, but the drawdown is far exceeds that. This does not bode well for the future. All right. So other risk metrics you may be interested in learning about are the Sharpe ratio, and this is a way of measuring the risk-adjusted return. We also have Sortino ratio, which only takes into account the downside variance or negative volatility, if you will, from a central tendency. Some also like the risk-reward ratio. So the risk-reward ratio measures a trade's potential loss versus its possible profit. So the ratio approximates the reward a trader may earn against the risk they are willing to risk. The idea, of course, is to seek these trade setups where reward outweighs risk. So if you're looking to buy from support, you want to see the opposing resistance at least twice the distance of the risk you've taken. So evidently, if you look for a larger reward, the more flexibility the trading account has regarding failed trades. The trade-off there, of course, is fewer winning trades as the take profit objective is set further from the entry price level. Now, here you can see that here's the basic calculation, risk-reward ratio. It's a maximum risk price divided by the total profit. So let's imagine our risk is $50 and our total take profit target is 100. 50 divided by 100 is 0.5. As you can see here, below 1, this is a trade that possesses a greater potential reward over risk. Over 1, so let's imagine our maximum risk price was 100 and our total profit target was 50. 100 divided by 50 is 2. So we are now above 1, and this is a trade that possesses a greater risk over reward. And if our risk price is 100 and our total profit target is 100, we have equal risk and reward. All right, guys. So do you have some guys? Okay, I see a question here. Do you guys have some risk assessment tools? We do have, we are now working with Trading Central, Maurizio. Do pop from your client portal, you can access all the different. We also have the traders tools. We have a traders toolbox there that may help you in terms of risk. Look in your client portal. To the left, there's a column. So we have Trading Central, we have Auto Chartist, we have also the trading tools. So you have correlation tools, for example, that can help with risk and things like that. All right, guys, let me just check. Bear with me. Just going to check questions. All good. Now, look, just to be clear that I have only really scratched the surface with risk management, but what I hope I have done is offered you something to think about in terms of managing risk, as if you do not, it will eventually turn back and bite you, if you will. Okay, let me just finally check questions. There's a question here. I'm just reading your question. Bear with me a minute. How can you get involved with Bitcoin? You can trade Bitcoin in a number of ways. There's the futures markets, there's the CFD markets, FP markets do offer CFD cryptos. There's a number of ways you can trade Bitcoin. Yeah, there's a number of ways. Options even. You can even buy it physically, I think, at the exchange, right? I've never really traded cryptocurrency, so I'm not sure, but I know a number of derivatives do exist for cryptos. All right, any other questions, guys? So look, guys, this really is the last webinar for the year. In January, I will be kicking off with a What's Ahead webinar for 2023 in the technical space, and that's on the 12th of January at 9 a.m. GMT. Also, I will be looking at trading strategies for beginners using news trading, and that's on the 26th of January, again at the same time of 9 a.m. Again, if there are any specific topics you would like the team here to talk about or questions related to the presentation, please be sure to send your suggestions to either the market analyst at fpmarkets.com email, or alternatively, as you can see on the bottom of the screen here, support@fpmarkets.com. Also, feel free to check out the Trading Hub, the FP Markets Trading Hub. This is packed with educational articles and analysis. And look, as I've said already in the presentation, we have a trading academy up and running. Please do go ahead and visit where you can look at a number of things: how to calculate your position size, what is support and resistance, what are trend lines. It really does give you a good stepping stone how to in terms of the markets. Yes, you're very welcome, Woody. I'm so sorry if I've pronounced your name incorrectly. You're very welcome, and a very Merry Christmas to you as well. Thank you very much. So look, I know I've thrown a lot at you guys this morning, but I hope it's really given you something to think about. And that's pretty much all I have time for today. Thanks once again for taking the time to join, and a very Merry Christmas to everyone who's joined. And look, as I said, I hope you're all able to walk away more informed than when you joined. Thank you so much, and I'll see you again in the new year.